What's up, everybody? My name is Keena, and on this channel we talk about trends in business, investing, and we talk about personal finance. So last week we heard Jerome Powell speak, as he does every 6 weeks or so after the meeting of the Federal Open Market Committee, or the FOMC. I think his speech lasted like 8 or 9 minutes, and in this video we're going to watch it, I'm going to break it down, explain the things that might be confusing, and most importantly, at the end, I'm going to discuss how the coming changes that they're going to make into 2022 are likely to impact your investments and any real estate that you have. I'll also have a special focus on inflation and supply chain problems. Those are just issues that we're all facing right now. So let's hop into FOMC Chair Jerome Powell's speech. Let's give it a watch. And again, I'll pause and add commentary as we go. Make sure you stick around for a deeper discussion at the end. Okay, let's jump in.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases. As I will explain, economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy.
Okay, let me stop here for a second. So I'm going to try to do and explain like I'm five for a couple of principles here. So there are two primary levers that the Federal Reserve has been using throughout this health crisis and throughout other crises too. Or crises too. Anyways, the first is the setting of interest rates, meaning the rate at which the central bank will lend to other banks in the U.S. system. This rate, in essence, affects the interest rates that you and I as regular people are able to get, since banks pass on the cost of higher capital or the higher rates directly to us as consumers. A general rule of thumb is to add 2 to 3% interest to whatever the federal fund rate is, and that's the prime rate, or the rate you would get if you had the highest possible, credit score. So right now, the funds rate is set at near zero, almost zero, which is considered, of course, very accommodative and supportive of the economy. So if you or I try to go out right now and get an auto loan or a mortgage, you'll probably be able to get something in the 2.5 to 3.5% range with excellent credit. So, just following this line of thought, if the funds rate were raised to 1%, then the best rate, or the prime rate that we could get would, for a mortgage, say, would probably be in the 3 to 4% range. Hope that makes sense. The second lever that the Fed uses is called quantitative easing. Chair Powell uses the term asset purchases, but this means the same thing. Basically, the Federal Reserve prints money out of thin air and buys large amounts of Treasury and mortgage-backed security bonds, thereby flooding the economy with newly minted money. The theory behind this is that added liquidity allows us to bounce out of a recession much quicker. But the downside is that it can lead to inflation, something we're experiencing right now. Okay, so now that we've got that out of the way, let's decipher what Jerome Powell just said. So first, he said that interest rates are staying near zero, as they have been throughout this whole crisis. And then he said that the taper has been sped up. So what he means is the Fed has been tapering off, or slowly ending, the quantitative easing program that started at the beginning of the health crisis. And now they're deciding to speed up that taper or end it faster. And the reason is, of course, that the inflation readings are high and they want to get the taper down. They want to stop the money printing. And then eventually, when that's finished, they want to raise rates, and that will help get inflation under control. So this is the biggest change announced in this meeting. They had planned to end the taper in summer 2022, but now the plan is to end it in March, so half as much time, or double the speed of the taper. Just one other side note, the Fed is not going to increase the funds rate or interest rates until the quantitative easing or the money printing is complete. So the implication here, and we'll discuss this more at the end, but the implication here is that if you do want to get a loan for something like an auto loan or a mortgage, you now only have a few months to get the best possible rate, whereas before we thought we had until June or July of 2022.
Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year and 4% next year.
Okay, so basically, economic output fell pretty significantly in 2020 because of the health crisis. But what Jerome Powell is saying here is that the experts are forecasting higher than normal economic growth this year and next. So whereas typically our economy grows maybe 2 to 3% each year in real terms, the FOMC board is forecasting 4 to 6% growth now in 2021 and then also in 2022.
Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward maximum employment. Job gains have been solid in recent months, averaging 378,000 per month over the last 3 months. The unemployment rate has declined substantially, falling 0.6 of a percentage point since our last meeting and reaching 4.2% in November. The recent improvements in labor market conditions have narrowed the differences in employment across groups, especially for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics.
So this part is pretty self-explanatory, but just emphasizing here that the labor market is getting back to normal and people are getting back to work. So
labor force participation showed a welcome rise in November, but remains subdued, in part reflecting the aging of the population and retirements. In addition, some who otherwise would be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. At the same time, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. How long the labor shortages will persist is unclear, particularly if additional waves of the virus occur. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September, participants have revised their unemployment rate projections noticeably lower for this year and next.
So Chair Powell said a moment ago that good progress had been made in the labor market. People are getting back to work, of course. The unemployment rate is at 4.2%, which is pretty normal here, a little elevated. But we still have an issue, obviously, with people not getting back to work. And I think there's a bunch of causes for this. Some are obviously directly related to the health crisis, medically vulnerable people choosing not to work. Some folks might need childcare or senior care that they can't yet get to return to work, that kind of thing. But there's also some factors that are less directly related to the pandemic causing this. Just in my opinion, I think some people have seen huge gains in their investment portfolios or with real estate. And maybe, families are deciding only to have one member work instead of both, both of the parents in that example. And lastly, I think that there's a social element here to the Great Resignation, as they're calling it, this kind of like pandemic-driven shift in the world. I think it's causing a lot of people to rethink how they want work to fit into their lives. Maybe they want to be remote, that kind of thing. And with all of this massive stimulus that the government has provided, combined with like asset class inflation, the way the market has run up, I think it's all giving people the luxury of taking some time not to work and really figure out what's next for them. So that would be my explanation. It's not anything Jerome Powell said, but okay, let's get back into the video.
Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% longer run goal.
You think 6.8% is almost 3 times higher than their 2% long-term goal.
And will likely continue to do so well into next year. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation. We are attentive to the risks that persistent real wage growth in excess of productivity could put to upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer run goal by the end of next year. The median inflation projection of FOMC participants falls from 5.3% this year to 2.6% next year. This trajectory is notably higher than projected in September.
Well, that would be an almost complete return to pre-COVID years. We'll see if that ends up happening.
We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee reaffirmed the 0 to 1/4% target range for the federal funds rate. We also updated our assessment of the progress the economy has made toward the criteria specified in our forward guidance for the federal funds rate. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. All FOMC participants forecast that this remaining test will be met next year.
Let's talk about the funds rate again here for a second. I said earlier that this is the interest rate that the central bank uses, charges when they lend to other banks, and of course it impacts the rates that you get. But given that, Chair Powell is saying two things. The first is that rates are not going to be increased until the taper is complete, which, should happen in March, and that they'll only be increased when the economy has reached maximum employment. And the test for maximum employment is pretty subjective. There is a framework for it. There are things that they look at, but basically it means maximum employment means when the unemployment is really low and everybody's back to work. We can expect the taper to end in early 2022, and then the rate hikes to begin not long after.
The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset purchases will better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions.
Okay, now that we've gotten through the speech, let's break down how this is likely to impact you and your finances. So first, rate increases are coming sooner than anticipated. This could happen as soon as March when the taper is complete. So if you were on the fence about making a big purchase with financing like a home or auto loan, the window to get the prime rate or the best possible rates is closing. Also, it's important to note that rate increases have wider ranging effects, although they're somewhat unpredictable. So let's talk about how it's likely to impact home pricing and the stock market as a whole. And right off the bat, we need to be aware that a dip in home valuations is very plausible as interest rates rise. And this is because history has generally shown that, all other things being equal, a 1% increase or decrease in the Fed funds rate causes around a 10% decrease or increase in home sale prices, like average home sale prices. So as an example, if the Fed funds rate were to raise from where it is now at about 0 up to 1%, that could cause home prices to fall by about 10%. And the explanation for this is that as interest rates rise, higher priced homes become less affordable because the monthly payments increase to cover the added interest. This causes demand for homes to taper off or decrease slightly, and it also shifts people into lower priced homes, forcing sellers to sell a bit lower. I think that's the best explanation I've seen for why this trend is seemingly true. So at this point, you might be wondering if you should wait for rates to rise to buy a house, because then maybe you could take advantage of a lower priced home. But my advice would be this: if you are thinking about buying a home and you have the ability, like the down payment and the ability to pull the trigger on that, I would do it now before rates change, because there's no guarantee that prices for homes will come down. And if they do, it might take months or even years for the market to react after the Fed makes changes, or it might not even react at all. Basically, my attitude here is that a bird in the hand is worth two in the bush. In this example, the ultra low mortgage rates that we're able to get now are the bird. And if you are currently a homeowner, I wouldn't be too concerned. Even if valuations dip, real estate still remains a great investment to hold on to, and it will certainly recover. Next, let's look at how these upcoming rate changes are likely to impact your investing portfolio. So something to know is that generally as rates rise, the stock market falls a little bit. And this is because both everyday people and businesses are now paying a higher interest rates whenever they finance new purchases. So the cost of capital is higher. So while rate increases are almost guaranteed to happen in 2022, barring some, crazy new strain or some change in the health crisis, there's no assurances that the stock market will react to the rate changes. Typically they do, but you don't know. And with the market at record highs, I just feel like a slowdown is inevitable, and perhaps even a correction. So let me tell you what I'm doing with my investments. So first, I always dollar cost average. For me, it's twice a month, and I do it into broad index funds regardless of how high or low the economy is. Since we've had a strong run up here in 2022 on consumer cyclicals and value plays, back to work kind of stocks, I am slowly rotating about 15% of my portfolio into technology, innovation, and crypto plays. These are all down pretty significantly in 2021, but in my opinion, we'll probably see a cycle back and a run up in those areas in the future. But that's just my opinion, and of course, it's not investing advice. And lastly, I'm holding on to more cash than I would normally. This is kind of a tough decision because inflation is so high, but I do want to be able to capitalize on any dip in the stock market if it does occur. So that's it, folks, for this one. If you found this video useful, please smash the like and subscribe buttons. That really helps me out. Thank you, and I'll see you all in the next one.